Fiscal policy can be defined as the government's actions to influence an economy through the use of taxation and spending. This type of policy is used when policymakers believe the economy needs outside help in order to adjust to a desired point. Typically, a government has a desire to maintain steady prices, an unemployment level, and a growing economy. If any of these areas are out of sorts, some type of fiscal policy may be in order. When an economy is in a recession, an expansionary fiscal policy is in order. Typically, this type of fiscal policy results in increased government spending and/or lower taxes in order to shift the low level of aggregate demand closer to equilibrium once more. Contractionary fiscal policy is essentially the opposite of expansionary fiscal policy. When an economy is in a state where growth is at a rate that is getting out of control, causing inflation and asset bubbles, contractionary fiscal policy can be used to lower it to a more sustainable level. In order to eliminate this inflationary gap, a government may reduce government spending and increase taxes. The Federal Reserve Bank in the United States has the ability to use monetary policy tools to help a nation reach a desired economic position. These monetary tools help promote output and employment, and also work to keep prices stable within an economy to ward off inflation. Changing the discount rate, changing the reserve requirements, and participating in open market operations represent the different monetary policy tools available to a country's central bank. The federal funds rate is the interest rate banks charge each other for overnight loans. When banks don't have enough money in their vault to meet their reserve requirements, they ask other local banks to front them the money, a band-aid fix. The Federal Reserve buys or sells government securities to impact the availability of money in the economy. The discount rate is the rate that commercial banks must pay to borrow from the Federal Reserve. When it is cheaper to borrow from the Fed, banks will borrow more reserves. When it is more expensive to borrow from the Fed, banks will borrow less. The discount rate is set by the Fed, generally a percentage point above the federal funds rate. Reserve requirements are set by the Fed, and they are the percentages of bank deposits that must be held as reserves. Resorting to changing the RR is as much as a last resort as open heart surgery because of its powerful impacts. Raising the reserve requirement may reduce the amount of money a bank has available to lend, while lowering the reserve requirement allows banks to loosen their lending policies. When the economy is in a recession, GDP, as well as price levels, are too low. Unemployment has increased and CPI has decreased. Expansionary fiscal policies are needed and can be combined with monetary policies to boost aggregate demand back towards equilibrium once more. The open market operations solution towards directing the economy out of a recession is through the federal government's purchase of securities. When the Fed invests in government securities, more funds circulate through the economy via the banking system, resulting in lower interest rates. With lower discount rates, the interest charged to commercial banks on received loans is decreased. With the lower interest rate, banks will be more willing to give out loans, and consumers will be more willing to take out loans in order to purchase things they have been holding off of because of the high interest rates. With investment and consumption increasing, GDP will rise. At all times, banks must be cautious of not loaning out too much money that they can't meet their reserve requirements. Rarely in a recession, the Fed may opt to lower the reserve requirements so that banks have more excess reserves and there is an increase in the money supply. Now, banks have more money to loan out for consumers and investors to circulate back into the economy, boosting GDP. When the economy is experiencing inflation, price levels along with GDP are too high, creating a bubble that's just waiting to pop. Unemployment has decreased and CPI has increased, seemingly good signs, but at a dangerous risk. Contractionary fiscal policies are needed, and when combined with monetary policies, together they can shift aggregate demand back leftwards once more. The open market operation solution towards lowering an economy out of inflation is through the Fed's sale of securities. When the Fed sells securities, it is decreasing the quantity of money in the money market system. With less money, interest rates rise, and with higher interest rates, there are less investments, making unemployment increase and consumption, investment, and aggregate demand all decrease. With higher discount rates, the interest charged to commercial banks on received loans is now higher. This means that banks will be less likely to give out loans, just as consumers and investors will be less likely to take them out. Only top priority loans are made, causing investment and consumption to decrease and shifting the aggregate demand line left towards equilibrium. During a time of inflation, the Fed may decide to increase the reserve requirements that banks are required to hold. By doing this, banks now have less excess reserves and there is a decrease in the money supply. This causes banks to be more hesitant with the loans they agree to, stifling unnecessary contributions of consumers and investors, ultimately lowering GDP. The money market represents the quantity of money determined by the Federal Reserve, as well as the price of money, represented through interest rates, since that is the amount that borrowers must pay to obtain money, as well as the opportunity cost of holding money instead of loaning it out. Since the Fed determines the quantity of money supplied, it is independent of interest rates and therefore is represented by a vertical line. Loanable funds are the connection between those who save and those who borrow. Loanable funds are exactly what they sound like, the amount of money that banks have to loan out to investors. When savers save, they are increasing the amount of money in the bank. Instead of banks just letting the savers' money sit around though, they loan out the savings to others looking to borrow and make investments. Loanable funds have a direct relation with the money market system. As the quantity of money in the money market system increases, interest rates decrease since the banks can now more easily meet their reserve requirements. With these lower interest rates, borrowing money becomes less of a risk, causing both the supply of loanable funds and the quantity to increase. Similarly to when the money market increases, the opposite effect occurs on the loanable funds market when the money market quantity decreases. Now that banks have less money in their vaults, they need to be more conservative with the amount of loans they give out. To lessen the amount of willing loaners, interest rates are increased, resulting in a leftward shift of the loanable funds market. This therefore decreases both supply and quantity of loanable funds. When the interest rate is low, investors benefit greatly and contribute in the inflating of the economy. At this point, the government steps in to crowd out investors. Crowding out is when the government enters the market and demands higher interest rates. With this increase of interest rates, the amount of investors decreases, and with the number of investors dropping, GDP shrinks and shifts back to the left once more.